Good afternoon, everybody, and welcome to the FX Traders Edge live market analysis event with Juan Maldonado and myself, Jody Samuels, for Thursday, December 1st at 4 o'clock Eastern. We haven't done this in a very long time, and I'm so glad that we're doing it for you today because certainly the markets are at a juncture, as you will see shortly, and we have lots of good stuff for you today. So let's get going. Please read the disclaimer to yourselves. Thank you. And in order to increase your viewing experience, I am going to plead with you to turn off everything operating in the background and silence your phone like I just did, close your door, and give yourself this time to see some great market analysis. So please take a few minutes and do that so you can focus on what you're about to see. Today, we are going to cover the following. I'm going to start by doing a fundamentals overview, looking at the key market drivers. What is the market looking at these days? And in particular, I'm going to drill down on this week because it was such a news-driven week and so fascinating. And I think it's a good teaching moment. And so not only will you learn a lot, but you will see how the markets reacted to these key market drivers and the news in particular. And then Juan is going to analyze 10 markets, including several currencies and the dollar index, the S&P, NASDAQ, natural gas, and oil. Finally, we are going to give you the opportunity to join the Elliott Wave Desk service so you can see more of this every single day. What are the key fundamental drivers? Well, usually when we look at the big picture view, we look at the relationship between stocks, bonds, the dollar, and gold. And that's called intermarket analysis. And that is key to understanding market correlations and what is driving markets. So sometimes these are correlated, sometimes they're not correlated. We're going to figure it out today together. And the main drivers in the current environment include growth, inflation, and interest rates, because you know that there has been a lot of talk about inflation getting out of control and how much will the Federal Reserve raise interest rates in the US. This week, we had a full calendar of reports. We had Fed speak on Monday, consumer confidence on Tuesday, GDP, PCE, unemployment, and we started out the week with a focus on China. Next week, we have a light calendar with PMI and PPI. So let's review these news releases with respect to the markets and look ahead for opportunities. We started off the week. So on the weekend, when we read the news or look for strategy reports, that's what I tell my students to do, to just look to see what the flavor of the week is. You saw a lot of information on China. So this week started with an eye on China as local authorities struggled with rising daily COVID cases and more lockdowns. And that would be a bumpy ride for financial markets with social unrest in China and negative global demand trends. So, what happened? We had a risk off start to the week where the dollar rallied and the stocks retreated. I'm going to show you that shortly. We also have an inverted treasury yield curve. So, on Monday, the 2-year bond versus the 10-year bond was minus 76 basis points. I'm going to put this into context for you by showing you a chart. But that is a view that recession is near and the Fed won't be cutting. They will still be increasing rates to combat inflation. And it's a more hawkish view So again, that stocks down and dollar up. Okay. So this is a picture of the 10-year yield in blue and the 2-year yield in orange. This is yields. And when you subtract the two yields, you get 76 basis point inversion. So meaning the 2-year yields are higher than the 10-year yields. And that spread has been widening, as you can see. Okay, so you can see that when we go back further, we had a normal yield curve to the left where the blue was higher than the orange. Now let's put it into context. So this is the inverted yield curve going back to 1980, and this is the 10-year Treasury constant maturity minus the 2-year Treasury constant maturity. When we are below zero, it means we have an inverted yield curve. So here currently where the red arrow is pointing, we are way below zero. I just showed you minus 76 basis points. We have an inverted yield curve. If we go back to the beginning where I have my arrows pointed, we had it in the late 80s. Okay, that's when we had the stock market crash. We had it in 2000. We had it in before the financial crisis, and now. And what happened subsequent to the yield curve inversions? We have this gray bar shaded area indicating U.S. recessions. So shortly after we had that inversion, we had recession, and it happens every single time. So there is a lag effect. We have it here, we have it here, and I suppose we will have it here. It doesn't show right now, but I suppose that it will. I mean, we have such a yield curve inversion. Okay, so that provides some context as to what's going on with the yield curve and recessionary views. Now let's look at the calendar. This is from Forex Factory. And we started out on Monday with FOMC member Bullard speaking. So I'm going to show you what his comments were. On Tuesday, we had consumer confidence. Wednesday, yesterday was a huge day, and you're going to see how the market completely reversed itself. ADP non-farm employment change, preliminary GDP, JOLTS job openings, and we're going to go through these. And then finally, Fed Chair Powell speaks. Today, we had core PCE price index, a measure of inflation, unemployment claims, and ISM manufacturing PMI. Tomorrow, we have employment numbers. So let's go through it and then look at what the markets did as a result of these fundamental events. So next week, by the way, we have a fairly light calendar. We have an important number on Monday at 10 o'clock, services PMI, and then on Friday, we have some important numbers as well. But it will be a lighter week than this week. On Monday, Bullard spoke, and this is what he said. Federal Reserve Bank of St. Louis President James Bullard said financial markets are underestimating the chances that policymakers will need to be more aggressive next year. So underestimating the chances that they'll need to be more aggressive next year and raising interest rates to curb inflation. That's very hawkish. That's what we call hawkish. There is still a heavy degree of expectations that inflation will go away naturally, Bullard said Monday in a webcast interview with MarketWatch and Barron's. U.S. stocks extended losses and Treasury yields rose following Bullard's comments. New York Fed President John Williams also issued a speech at about the same time saying officials have more work to do to curb inflation that remains far too high. So in essence, that's sort of scaring the market into thinking, okay, we're going to have a bigger increase in December. Rates are here, high rates are here to stay, and we're going to have increases. Inflation is out of control. So this was very, very hawkish and bearish for 4 stocks. That was on Monday. Now let's look to see what the market did on Monday and also how it affected the dollar. So on the left, I have the dollar index, and on the right, I have the S&P. So let's talk about the dollar. These are the Monday comments. Now, we also had the China comments over the weekend. So what happens to the dollar? The dollar moves up. These are hourly bars, candles. The dollar moves up. This is a dollar index. So the dollar index is moving up as the market is expecting higher interest rates. Okay, so when there are higher interest rates, there's more flow into dollars. And that set a bearish tone into the stock market. So this is Monday's price action. Bullard spoke right over here, and the market started to trade off. Now, that was Monday. That was the tone for the week. And thinking that, okay, on Wednesday, maybe this will be confirmed. But let's go on and see. So I just took the daily chart for the dollar index and the S&P, and you can see that the dollar had a strong weekly candle. This is a daily, so closing at the day's highs, but at a little bit of support here at the tunnel, and then stocks traded above the tunnel and came off. So this was the price action on Monday. Now let's look at Tuesday. And what I like to do, by the way, is I like to look at the news in advance on the weekend to see what's coming out during the week and be prepared, get prepared that way. On Tuesday at 10 o'clock, we had the Conference Board Consumer Confidence. So let's read this. The Conference Board Consumer Confidence Index decreased in November after losing ground in October. So this is the release. This is from Forex Factory. The market was forecasting 100. The previous number was 102.2, and the actual number was 100.2. So weaker from the previous month. Now let's just read it. The index now stands at 100.2. The baseline is in 1985. At 100, down from 102.2 in October. The present situation index, based on consumers' assessment of current business and labor market conditions, decreased to 137.4 from 138.7 last month, so that's weaker. The expectations index, based on consumers' short-term outlook for income, business, and labor market conditions, declined to 75.4 from 77.9, so weaker. And what is this Conference Board Consumer Index based on? It's a survey of about 3,000 households, which asks respondents to rate the relative level of current and future economic conditions, including labor availability, business conditions, and overall economic situation. So it's a survey among 3,000 households. So this is a little bit weak. Let's look to see what the markets did. One would expect, if that was a little bit weak, one would expect that okay, so this is where I have the arrow. This is where the consumer confidence came out, right over here. So it was a volatile candle. I guess it sold off and then it snapped back, and the dollar continued higher. Okay, so again, a weak number. The S&P continued its bearish tone. This is all the while everybody is waiting for the more important numbers on Wednesday. This consumer confidence number was not one to reverse the market until Powell speaks on Wednesday and until all the other numbers come out on Wednesday. So even though it's a little weaker, it doesn't do enough to reverse the trend. Okay, the market tried, but it didn't carry through. So Monday, strong bullish rally. Tuesday, we have a correction, and then the dollar continues higher. Tuesday, Monday for stocks, they sell off, and then we retrace, and then they sell off again. Now, let's look at Wednesday. On Wednesday, the first release came out at 8:15 with ADP non-farm employment change. It was weaker. That stands for automatic data processing, non-farm employment change. The private sector employment was increased to 127,000 jobs, which is less than expected. It was forecasted to be 196K, and the previous was 239K. So weaker, okay? Weaker number. At 8:30, preliminary GDP came out. It was pretty well mixed, in line with expectations. At 10 o'clock, JOLTS, which is Job Openings and Labor Turnover Survey. And the key there is that it reversed the surprise jump in the prior month, which is a hopeful sign for the Fed as it seeks to curb demand across the economy in line with expectations. So the prior months with 10.69 million job openings, and then even though the forecast was much lower than that, 10.24, it came in low at around 10.33. But I'll say it's a little bit mixed, okay? But it's probably in line with what the Fed wants to see. Okay, they want to see job openings coming down. If this inflation, they want to see weaker economy so that inflation is tamed. And then pending home sales, it declined for the 5th consecutive month. So that's definitely weaker. Okay, that's definitely weaker. Then Fed Chair Powell speaks at Brookings Institution in Washington. And he said, now don't forget, the market has already sold stocks, bought the dollar, thinking that he's going to confirm the hawkish view and the bullish view on rates. And he says that the Fed may increase the rate by a smaller increment of 0.5%. So the market was looking for a 0.75% possible hike. But he's talking about a smaller increment, but will keep rates higher for longer. So the market shrugged off, will keep rates higher for longer, focused in on the less hawkish statement, and less hawkish is risk on. Less hawkish is risk on because it means maybe rates aren't going to go up dramatically, and the market took that as a sign to buy stocks and sell the dollar. And this is what happened. So this was Wednesday. So the dollar sold off and stocks rallied. So I looked at Monday and Tuesday as really a wait and see before Powell was going to speak on Wednesday. And what is the best way to take advantage of something like that? Well, really the only way to do it is to be there when the news comes out and react and see that the trend has changed, or you can draw your channel lines and see what would happen. For example, if we broke above here, what would happen? It would likely trade higher. And you can also have an Elliott wave view, which one is going to give you, which would have told you the expectation of higher. Okay, so in order to catch something like this, the preparation, being prepared, is key. It's too easy to get flustered when the news comes out and just to jump in like a day trade. No, preparation is key. And that comes with doing the analysis, whether it's fundamental analysis like this, or getting your Elliott wave analysis for what the market is anticipated to do. So this was very interesting, but we're not done yet. Okay. look what happened to the 10-year, 2-year spread. It narrowed a little bit. It narrowed. So the inversion moved to 72 basis points. And I didn't check it today. This is yesterday. So 72 basis point inversion from 76. Okay, not a big deal, but the market looked at this and the blue, the 10-year rates came down a little bit more, as did, and the 2-year rates came down a little bit more. That's what happened. Okay, so 2-year rates came down a little bit more, and the 10-year rates came down as well. So the spread narrowed. Now let's look at Thursday. That's today. At 8:30, we had the core PCE price index, and that was weaker. So that's the weaker than expected. Unemployment claims were mixed, and the ISM, which is the Institute for Supply Management, Manufacturing PMI, Purchasing Managers Index. Let's read this. U.S. manufacturing contracted in November for the first time since May of 2020, as output weakened in the face of a third straight month of shrinking orders. And when it says that it contracted for the first time, it means that the ISM's gauge of factory activity slid to 49 from 50.2 in October, and it crossed the 50 threshold. And 50 is the threshold to separate the expansion versus contraction. So it went below 50 for the first time since the pandemic lockdowns. So that's not good. I mean, that's weaker, right? That's weaker for the economy. And that is something that would probably encourage the change in view to increase the rates by 0.5% in December, and not go gangbusters in increasing rates a lot for the next several months. Okay, so that was the message that we got. So bad news is good news for stocks and bad news for the dollar. What I mean by that is when you have weaker numbers, that's bad news for the economy, but it's good news for stocks. That's risk on, okay? And bad news for the dollar. So the dollar is now driven by interest rate moves. If it's bad news for the dollar, it just means that if interest rates aren't going to go up as much, it's bad news for the dollar. So this is sort of what's going on and how we can read the correlations in the market. So here we are for Thursday, and you can see that we went from risk off at the beginning of the week, and risk off, it's easier to see with the stocks on the right, where on Monday, Tuesday, stocks sold off into Wednesday, and then risk on. Okay, today we had a consolidation day, and we had some releases too, so you can see this, the wick, but we went up so much, it's not surprising that we had consolidation today. And on the dollar side, we had a complete reversal. Dollars moving higher. And when you say this is the dollar index, so that would mean like it would be the opposite for the euro, for example, and we'll look at those currencies in just a minute. So dollar moving higher and then dollar selling off. And I read somewhere, I saw somebody said in one of the comments, a Forex trader said, gee, I wonder why the dollar is selling off. It's good news. So he was looking at the stock market moving up. Why isn't the dollar moving up? So I'm trying to explain why. Okay, from risk off to risk on. Okay. And then what's going on? What's happening tomorrow? Tomorrow is also going to be a big day. We're getting average hourly earnings, non-farm employment change, and the unemployment rate. And what is the Fed looking for? The Fed is looking for a weaker job market. So a weaker job report on Friday will be positive for stocks, risk on, and negative for the dollar. So remember, bad news is good news for stocks and bad for the dollar. And we have a clue from Wednesday's ADP non-farm employment change, which was weaker. Job gains were the weakest since 2021. So that could be what we're facing tomorrow. But I'm not going to tell you that we're going to go straight up for the stocks or down for the dollar after tomorrow's numbers, because we have moved a lot, but you know the flavor. But we do have to take into account the market breathing. So the Elliott wave analysis, the trends and the corrections, the trends and the corrections. This can tell us what the trend is for a bit, but we also, the market breathes. It never moves in one straight direction without breathing, without correcting. So looking at the currencies just quickly, we said dollar up since Wednesday. These are the last two candle. So dollar, wait a second. This is euro up, dollar down, Wednesday, Thursday. Look at this. And then prior to that, Monday, Tuesday, euro down, dollar up. So dollar down means euro up. Dollar down means pound up. You can see the green candles. Dollar down means Aussie up. You can see the green candles. Dollar down means New Zealand up. Two green candles. Dollar down means US dollar Canada lower, red candle, and then correction. And dollar yen, two strong red candles down. So it was pretty clear across the board. Dollar move, dollar up move Monday, Tuesday, down Wednesday, Thursday after Powell speaks. And on stocks, question here is, have stocks bottomed? And Juan will answer that for you when he does the analysis. But looking at the weekly charts, I've circled in red the bottom for the S&P, for NASDAQ, for the Dow, the Russell. I put in the Nifty here, and the Nikkei. So these are all weekly charts of the indices, and we had a really, really steep correction in all of these indices. So really the question is, have we turned the juncture? Are we going to be moving higher, or are we going to see another low, or are we in for some consolidation? And I'm going to leave that for Juan to answer for you. And looking at the daily, just again to reiterate what we already looked at, this was Monday's price action, all the stock markets across the board selling off, and then Wednesday's price action, lift off, lift off, lift off, lift off, lift off. Just to summarize, and I'm just going to show one chart of stocks, bonds, dollar, and gold, and then I'm going to turn it over to Juan. Risk on trades with the view that the Fed will be less hawkish and that inflation is being tamed. So what is the reaction? Stocks up, dollar down, gold up, and bonds up. Bonds up means bonds up, prices down, meaning interest rates. The market is seeing that, okay, maybe interest rates are not, they're pausing, they're not moving up. So bonds rallied. So this is the four markets and how they are reacting off one another in a risk on view. The risk off trades with the view that the Fed will be more hawkish with more rate hikes to tame inflation. Stocks down, dollar up, gold down, and bonds down. So you can sort of keep this chart up if you want, and then have a look at the markets when you're looking at the news releases every week, and see if these relationships are holding, and maybe it will help you in determining your view of what the market is doing along with your technical analysis. So let's just prove that this is the case and look at the four markets together. So on the left, we have the euro. So euro up means dollar down. On the right, we have gold higher. And usually there is an inverse relationship between the dollar and gold, by the way. So gold higher. And if you're trading silver is actually moving up more relative to gold. But I put up gold. And then we have the Dow in the lower left. So Dow higher, and we have the 10-year bond, so bond higher. So this is the relationship for the risk on trade. Let's see if it holds. And I wanted to show you one more thing before I turn it over to Juan. I just want to show you how this changed from Monday to Wednesday. This is the CME Fed Watch tool on Monday, where it showed the target rate probabilities for the December 14th Fed meeting. 69.9% of the analysts surveyed were anticipating a target rate between 425 and 450. Current target rate is 375 to 400. So roughly 25 to 50 basis point. Is this? Yeah, hike. So 425 to 450. Take note of the 69.9%. And look at how that number jumped to 79.4% on Wednesday, thinking that more analysts are in agreement that we will have this kind of a hike and not anything more than that, which is the minority. And if we move ahead to February, on Monday, 33.3% saw that in February rates would be between 450 and 475. So again, a little higher, but look at how that jumped to 46.4%. Being at the low end of the range. So you can see how by looking at all the news that comes out and the news that comes out definitely affects the Fed Watch tool, what the Fed is doing. That's what they're watching. They're watching for signs that the economy is cooling down and that inflation is cooling down. And here are the major central bank interest rates. So you can see that the Federal Reserve current interest rates are higher than all the others except for the Reserve Bank of New Zealand. So you can take a look at that. And now I think I've said enough on the fundamentals, and I'm going to turn it over to Juan, who's going to take this and show you what his outlook is on the euro, the pound, the Aussie, the dollar yen, Bitcoin, the dollar index, the S&P, NASDAQ, natural gas, and oil. And then when Juan is done, we will share the opportunity to join the Elliott Wave Desk service, and we're going to show you stats, and you're going to be blown away by how well this service is doing. But I'm going to keep that until the end. So now I'm going to turn it over to Juan, and thank you so much.
Thank you, Jody. That was fantastic. Hello, traders. Welcome to this great webinar that we are having today. After that fantastic fundamental approach, we have a clear idea of what's going on. We are in complex times, clearly the highest inflation in the last 30 years. So of course, for a lot of traders, it's the first time that they are living and they are trading under these complex markets. But it's exciting because it's an opportunity to learn, it's an opportunity to understand all these complex fundamentals. And of course, as traders, we need to combine these fundamentals with the technicals, because no matter if you are a long-term investor, a day trader, a scalper, a swing trader, the setups that we can have from the technical analysis side, from the chart, are going to give us an edge, because we can have setups with low risk and high reward. That's the basis of the good trading, risking just a little and trying to make a lot, and that's the way to survive in these markets. And that's where the Elliott Wave theory comes in to help us to understand the previous cycles and come with a clear idea of what to do to have a bias for the session, to get validation points, and of course, to have this additional point of view in order to find some good trades. We are going to talk about different markets today, and the plan is to show you some previous trades, what is happening now, and what we are expecting for the rest of the week and even for the rest of the month of the year. So let's start with the euro. This is a daily chart. On this daily chart, we are seeing a change of behavior. The euro was going down and eventually started to turn up. And so far, it seems that we are in an impulse. The Elliott wave pattern that tells that the market is switching from bearish to bullish or from bullish to bearish is the impulse. And actually, it's pretty simple. It's a 5-wave sequence, 1, 2, 3, 4, 5. And after the 5-wave sequence in one direction, we look for the test. We look for the corrective pattern that is an ABC. And once we have the ABC, then comes a big wave 3 that, of course, is a fantastic cycle because the corrective waves are just tiny during the wave 3, and it's a great cycle. So on this chart, we are seeing the impulse on the euro. Let me highlight the waves for you. 1, 2, 3, 4, 5. As you can see currently in the live market, we are inside the wave 5. Of course, we are going to move to lower time frames to talk more about this wave 5. But as you can see, the main plan is that soon we are going to have a retrace. We are getting closer to the end of that impulse. And once the corrective wave starts, we can retrace 50% of this leg or something like that. And we can go long after the wave 2. But while that happens, because of course it's gonna take some time, we can move to lower time frames to find faster trades, to find the bias inside, and to create a trading plan based on the Elliott wave theory. So first of all, the euro was trending up. That's a fact. That's easy to see in the chart. But at a random level, the price found a resistance, as we can see in this area. And we have, for the first time since the wave 3, this wave 3 started down here, is the whole move up is the wave 3. And it started for the first time that is low down in the trend, and the price switched the bullish trend to sideways. Now we are in this area in a sideways price action, and that's the first step to have a trend reversal. Because when the price is trending in one direction, you can't fight the trend. The trend is your friend. Don't try to catch the falling knife. Don't fight the trend, and all those concepts that are completely true. But once we have that stop in the trend, once we have that price moving sideways, the flag, right, bullish flag, is when we start seeing that trend that we were seeing is not active anymore. And that's a key part of the reversal. So once we have the price coming up here to the previous high, and if we have a rejection, I'm going to describe that in a second, but that means some sellers coming here the high. That's where we can say, okay, our trend, it's done, and all the short trades are welcome, and that's where we can have the trend reversal. So as you can see, this pattern that I'm drawing here is happening exactly the same on the euro. Of course, in technical analysis, we are going to have different patterns, but at the end they are going to look the same. So this week we have been looking for price to test this upper area. From there, we could have a strong rejection from that area. And this is interesting because we have a Telegram channel where we share the trades with our clients. And the plan this week was to sell the euro, the 104.70, with a stop loss at the 105.05. So we are talking roughly 35 pips of a stop. And this was a beautiful setup because we were able to sell this rejection right there at the extreme at the 104.70, and the price moves in the direction, in the short direction, for 170 points. But after the Fed, I was looking at that moment to see the price moving a little bit lower here to test this area. And if we have a breakdown to hold the short trade, on the other hand, if we have the price rejecting this area to go long or something like that. But after the Fed, we have this huge candle. I was not expecting that candle, but we were short from the high, so that's fine, right? Enough to book some good profits. 170 points in a trade, not bad, or at least to capture 100 points while tightening the stop. But now that we are again on this key area, we have to get ready for the short trade. And here comes the question: how? The timing, how we can trigger, where we should try to trigger. Because one of the biggest mistakes that I have been seeing a lot in traders, and not only using Elliott wave, using any technique, is to believe that in this case we're using Elliott wave, is to believe that, oh, that's the wave one. So you are suggesting that after one, the retrace is going to start. So just with that piece of the puzzle, traders start selling, right? And you ask the trader, hey, why are you selling at this level? And the answer is because wave one is almost done, and I have to sell because I don't want to miss wave two. And that's a huge mistake, because what if wave five becomes extended? What if tomorrow, after the employment, we keep seeing big candles here? And what if the euro comes to the 108? What if the euro moves 200 points more to the upside? So that trader is gonna finish extremely frustrated, because he's gonna say, oh, the Elliott wave theory doesn't work. It's too subjective because I couldn't find a good entry. So what if, instead of thinking like that, we wait for sellers at this area? So let me move to the hourly chart so you can see an example of a trade that already happened. So then you can just copy and paste the concept on the actual price. So as you can see here on this area, we have the price rejecting, right? That's clear, that's simple, that's absolutely easy to see. So that day, when I start seeing the rejection, look at that beautiful spinning top in the area that we were looking to find the reversal. That's why 1 pip under the low of that candle, I place the sell stop order, and it was a beautiful trade. Now let's repeat the same process on the actual price. So let's bring back the resistance line, and we can see clearly on this area that we didn't have any rejection. The price didn't close under this area, under the previous wave 3, right? And the momentum is pretty strong. So traders, this is going to be actually pretty simple. We need to have price coming up here, rejecting after crossing 3, showing a nice reversal candle, let's say a bearish engulfing candle, an evening star, anything. And that's going to be our first short signal, the aggressive entry. The risk on these type of trades is pretty small because we can leave the stop loss at the high. So this is the risk. And we have a huge potential to the downside. But look that I'm waiting for the signal. I'm waiting for the bear candle to show up in the level that I'm looking to find the candle. So that will be the bear signal. If we want to have an extra validation, for some traders, this is not enough. So we can wait for a little bit more of candles. Better if they close under the previous wave 3. And thereafter the ABC, we look for a second rejection inside. And that could be the second entry, or we can start building different strategies. For example, triggering half of the trade here at an aggressive level and adding to the position at wave 2. This would be wave 1 and this would be wave 2, right? So this could be an interesting setup that we can follow on the euro. And of course, if you sign up for our membership, you are going to receive the daily analysis with all these details. All right, so this is the pound. Let's have a look at the pound. This is going to be similar. A spoiler alert is going to be similar. The analysis here on the pound, because this is a dollar trade. But that's the beauty of these markets, because we can pick. Once the setup is ready, we can pick, oh, okay, which one looks better? Is the pound better than the euro in terms of risk reward? And we can pick. So the plan on the pound is having the wave 3, it's the same plan as the euro, a corrective 4, another move up. Look at the rejection here that we are looking, and that's the sell trade. And of course, if you are scalping, if you are day trading, you are going to repeat this process, right? This is going to be pretty simple. Let's have a look at the Aussie. On the Aussie, before I share with you the view on the live market, let me share with you a great trade that we did here on the Aussie. This November was great. It was great. So look, this was November the 21st, and we were looking to go long at 66.18 with a protective stop loss at the 65.80 and a take profit of 68. As you can see in our trades, the risk reward is fantastic, right? It's pretty good. Usually we risk 30, 35 points, 40 points at the most, and we go for a lot. So let's review this trade. So in this case, we have the price building a corrective wave. We were looking for the end of wave 4. This wave 4 here, we have the wave 3. So this was a corrective wave. And if you don't know anything about the Elliott wave theory, don't worry, because that's why we provide this analysis every day. So you don't have to be an expert on Elliott wave. Of course, it requires a lot of effort, a lot of time to be good at Elliott wave, but we can do this for you, and it's going to be pretty easy to follow. So look, we have the corrective wave, and that morning I was telling in the daily video that we were here when I was recording the video that morning. We were here on this area. So my plan, the trading plan for that day, was to look for a rejection. That means a candle closing above the previous corrective wave to trigger the trade and target the previous high. Right. So that was the plan. But instead of having the price closing above this area, we have another sell-off, as you can see. But thanks to the Elliott wave analysis, we knew that the price was getting closer to the end of the leg. So when we have that sell-off, I draw this line here because I'm looking for buyers. I don't want to fight the trend. I want to look for some buyers. I don't want to buy at the downtick because I'll be alone. I want to see first some buyers coming into the market. So look at these beautiful buyers right there. And that's where I said, okay, we already assess everything. In trading is going to come with some risk, right? So this line is where I trigger. And I leave a protective stop loss at the 65.80 right there. So this was the risk on this trade. Right there, we have the risk. And the reward was to capture something here to the 68. So you can see how a good deal, how a good trade in terms of risk reward was this one here, right? So the price departed fast to the upside, fantastic. But look at this tricky part on the trade. The price fails to make a hard high on this area. So during the process, we book partial profits, right? Because anything can happen. And after that impulse, the price started the corrective wave. But look, here happens again. I was keeping part of the trade active, a fraction of the trade. But look at this beautiful entry. I didn't take this one. But as you can see, it's a copy and paste. If we copy this signal here, is exactly the same as this one here. Right? They repeat and they repeat and they repeat. Right? And you may be thinking, okay, but how you can tell that there is that one and maybe not somewhere something higher here? Well, in this particular case, we didn't have any signal before. Right? The signal is price breaking down the corrective wave, in this case A, and closing above A again. Never happened. We have a huge sell-off. Price returns, can't cross the level, leaving a tail, price moving down again, absorbing stops on this area, rejecting, and there we have another entry. Right? So now, traders, we're going to repeat that in the live market. The same process, because we have a fantastic Elliott wave structure. So listen, this is going to be pretty simple. We are in the wave 4 right here. Price was building. This is a complex, a corrective wave with a lot of volatility today, as you can see. It seems that this corrective wave is done, and we are going to have a hard high here. Another leg up. If we have a nice red candle showing up here, same as we were seeing here, same as we were seeing here, right? We sell right there, and we leave a protective stop loss a couple of points above the high. So that's the risk. We can book some profits in this area when the price comes here. The 68 will be roughly 30, 40 points once the price is there, and we can book some good profits. And if it breaks down, we hold the trade. That's it, right? It's pretty simple. So this is the process, of course, based on the wave count, on the Elliott wave theory. Let's have a look at the dollar yen. On the dollar yen, that same week that I was looking for the sell trade, here happened something extremely interesting. So let me show you. that day was the day before Thanksgiving. So I said, oh, I have already, I have a euro pound trade at the time, and I was holding my Yossi, and I said, it's a holiday and everything. I say, I'm not gonna trade this one, but I share it on the daily video. So we were live here, and look, it's the same process. We have wave one, the corrective A, the corrective B, and the corrective C leg. And look this thing. What a beautiful signal right there. Because the main plan, when we are finding the end of the wave, is to find out that we are not alone. We want to see, before triggering the trade, that the institutions, whatever you want to call them, the others, whatever, are selling, and that tail on the hourly chart is key. But one of the most exciting part of the Elway theory is that you have levels. You have levels to act, because we know that candlestick patterns are going to show up all the time. But when you add that price action reading with the Elway theory, is fantastic. So that was the entry. I didn't take it because I said it's holiday. I already have 2 trades. I'm conservative with the trading plans, but I explained it before the fact on the daily video. And then later that day, I was seeing the chart, and I said, wow, oh, I'm having feelings of regret because I didn't trigger the trade. Oh, what a beautiful thing. And look all the points that the dollar yen moving in one direction. All right. But now let's talk about the actual price to have a plan. So this sell-off was pretty strong. Look, if we were looking for a buy trade, let's say, you can see that when we wait for the right signal, we are not going to make mistakes most of the times, because look at this thing. We have a strong supply crossing support. So there is no way. Look at this sell right here. Look at the difference in terms of price action. We have a tail at the resistance. We have the rejection. So that could be a sell trade. We can leave the entry point under the low of the candle. But when the price comes to support, look how the price is breaking. So there is no way trying to go long right there. Price accelerates a lot. We are in the wave 3. And the next step in this process is to start seeing some buyers. That's the logic behind wave 4 in Elliott, having some buyers on the left. Then price making the low, but this time not breaking down strongly. If that happens, you are not doing anything. But if the price comes down here and rejects and moves above 3, that's the signal. That's the signal right there. And the protective stop loss is going to be under the low. That's it. It's so simple once we have a wave count to trade. Let's have a look at the Bitcoin. The Bitcoin is in real trouble, right? FTX is out of the market, and Binance is trying to do a lot of things to recover this market. So with all these bad news, that the crypto market, not just the Bitcoin, the whole crypto market is suffering, I believe that is not a good idea to invest on the long term on these currencies. So the wave count is telling that on the left we got a wave 3 after the last big sell-off, and is creating this bracket right there. That's the corrective wave. Ideally, technically speaking, we should have price coming up to this area selling off from there because as traders, we sell at higher prices, selling the rejection there, and we can target the previous low. I'm thinking that what is going to happen on the Bitcoin is we are going to have a strong breakdown here, and we could very easily reach the 10,000 or lower. That's what I'm thinking. But of course, the timing is key, because we can't sell here once it breaks down. What if it rejects? We always sell at the opposite extreme, always. So the plan will be to check what's going on here. Now, if price, let's say tomorrow, let's say Monday, whatever, comes above this area and can't sustain, and we have some big sellers, probably even closing under this previous wave 4, here we can add an extra validation just in case, then a little retrace as a wave 2. From there, we can tell that the wave 4 is done before moving above this high. And from there is where we can have this big sell-off on the Bitcoin. So let's get ready. Seems exciting. Let's have a look now at the S&P. Wow, the S&P, so fantastic. So the big question, right, is this the bottom of the market? Are we ready to go back to the previous high? Or the S&P is crashing and is gonna make a lower low? Well, the short answer is that nobody knows, right? Nobody knows with a 100% of probability what is gonna happen with the S&P, because it's complex. How we can forecast if inflation is gonna keep slowing down, if the Fed is gonna keep that narrative, or if something big changes, and a lot of things that are out of our hands. So we shouldn't be worried about that. As traders, if the price moves to the 5,000 area or to 2,000 area, we need to make money, right? That's it. So my point is that with the strategy that we are going to create today, it doesn't matter if the S&P goes up or down, right? So it's going to be actually pretty simple, traders. So first of all, we are testing a key area on the daily chart, as you can see, a simple trend line connecting the high with the retrace, with the other retrace, and with this thing that we don't know yet if it's a retrace or not. So to keep it extremely simple, traders, the S&P is going to finish this wave 1 orange soon, and we are going to have a retrace. If this retrace moves slow, and by slow I mean small candles, taking its time, building a 3-wave sequence. After the 3-wave sequence on this area, seeing some buyers entering here, right there, traders, is where we are going long for the long term, if you like. That's going to be a great signal and could be the last point of retrace for a huge move up, right? So that's simple. Now, what if the price starts selling off as strongly as it did before? Here, 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 here. Well, the difference between a corrective wave and an impulsive leg is that the candles on the impulse are going to be big, are going to be trending in one direction. So in that case, from the first candle or the second candle, we are going to confirm that we are going to make a lower low, right? So the next question is, if that's the case, how we can capture the leg down? And the answer is extremely simple, because once our wave 1 is done, and we are going to lower time frames in a second to show you how we can find the end of one, we're going to sell it. with a tiny stop loss, a small stop loss, 10, 20 points of a stop loss. That's it. On the ES, or if you like to trade the SPY or options or anything, is going to be the same. And if we have the bullish pattern, the corrective wave, well, we close the sell trade and we go long. So we close the short trade with profits and we go long. On the other hand, if we have these big candles, we keep the short trade and that's it. Right? It's pretty simple. Because the reason why nobody knows in this world what is going to happen is because with the information we have these days, with the Fed starting to slow down the interest rates, the hikes in the interest rates, that's a good message for the market. And if they keep doing that, and probably they pivot, if they just sustain the rates where they are next year, well, the S&P is going to the moon. But on the other hand, if inflation starts moving higher again, and the Fed says, you know what, we're going to increase the rates, this market is going to drop. And it's impossible to know which of the two scenarios is going to happen. But it's possible to have a position on each. And that's what matters, because we make money. So let's have a look at the hourly chart. On the hourly chart, we can create a plan for tonight if you trade the futures. So it's going to be pretty simple. The plan is to have price coming down here to where the wave A finished. Once the price rejects, so again, it's a simple concept. Imagine a hammer, bullish engulfing candle, anything that shows buyers at this area, protective stop loss under the low, tiny risk, potential, the previous high, right? That's the bullish trade. Simple. Once we get here, that's where I'm going to start selling for that daily chart scenario, because that's the completion of wave 5. So I'll be looking for price moving above 3. The price can move 10 points, 80 points, 40 points above 3. We don't care, because we only trade when we see the sellers jumping into the market. That's our validation. Of course, if we have here green candles tomorrow after the employment and the S&P comes up to, I don't know, 4,500, something like that in one candle, well, we are good, because we are long from here. And we don't close the bullish trade if that happens. If we have the sell trade, and if we have a bullish trade before, we close the bull trade and we go short, and that's it. And of course, that's also reading candle by candle. If you're scalping, if you are day trading, then you're going to sell this B. So you perform the same exercise, but you go to the lower time frames, or 5-minute chart, let's say, right? So you come here and you say, okay, I have my corrective wave. A price here builds the rejection, right? Here is the entry point when the red candle closes, protective stop loss here, stop loss here, and the profit is here. And during the road, you book some partial profits. If you were thinking that this was the validation and you sell here and you leave the protective stop loss here, and the price makes this leg, is enough to book some profits, or at least to move the stop loss to the break even. And then you try it again. That's the magic behind the corrective waves, because it's impossible to know precisely which high is going to be. We need to start trading once we start seeing the corrective developing, and that's it. It's actually pretty simple. The Nasdaq, similar, so it's the same as the S&P. So looking here for 4, 5, the rejection, and exactly the same plan. And let's have a look at the dollar index. So the dollar index has been selling off strongly, and in the LOA theory, after the 5-wave sequence, we are having the corrective wave. So after this 5-wave sequence, as you can see, we are pretty close to the end. We are pretty close. Yeah, it can extend a little bit more, this leg down, but once the price starts rejecting this area, we are going to have the corrective, and that corrective could very easily retrace 50% of this leg, right? And then we sell it. So one step at a time. Now we need to focus on finding the end of this leg to go long on the dollar. For the corrective, as you can see, is the same logic as selling the S&P. It's actually the same trade, right? And once this wave 2 is done, we can short the market. But of course, we need to validate candle by candle. Here we have natural gas. On natural gas, I'm looking for a sell trade. I have been waiting for this trade. So look, here we have already a validation. Right? Price comes above this corrective wave, rejects. But thanks to the wave count, I know with a high probability that on natural gas, we are going up here to the previous high. We reject from there. That's the sell trade. In the meantime, we can take advantage of these rejections to go long. Look all these tails. Look all the demand that is entering the market on natural gas. So it's ready. It's ready. If we want to have an additional validation, we can have a buy stop above the last candle, right? Just to make sure that some good demand, some quality demand is triggering the market to trigger the trade, protective stop loss under the low. And once it starts moving in our favor, we book partial profits, or we tie to the stop loss, or anything that we like to do to manage the trade. Oil is one of the most complex markets this year because the war, because the OPEC cutting supply, because inflation. So this market is complex. However, is tradable and is interesting as well. So oil, we have to be careful because look, already finished this cycle here. Look at that beautiful entry here at the low of the market. Price comes down, can continue lower, rejects, easy. And now the plan is having some sort of ABC here for B, a hard high. As traders, we sell expensive, and we can give it a try right there for selling the wave 4 and trying to capture this leg down back to the previous low. So if you are trading CL, or you are trading a CFD, or you are trading an option, or a Brent, or any oil that you like, just check your chart to find the levels, because are going to be different to mine. Check your chart, draw the key lines, and wait for your signal, and that's it. It's actually pretty simple. All right, traders. So this is the analysis for today. Thank you very much for watching. Now Jody is going to continue with the webinar, and I'm looking forward to see you in the membership to continue working together, to continue sharing this great analysis every day with you, and teaching you how you can manage your trades and how you can trigger your trades based on the Elliott wave theory. So thank you very much. And now Jody continues with the webinar.
Thank you so much, Juan. Since I just know you loved Juan's analysis, he's so great, isn't he? And the analysis can really provide guidance for you. So do you want to know how to enjoy a full month of analysis on your favorite markets? The Elliott Wave Desk will help you amplify the performance of your trading while tearing down the barriers that are constantly holding you back from that next level. I know that all of you have it in you to get to that next level. Well, maybe this can help you. And all you have to do is go to elliottwavedesk.com/join, and this is what you are going to see. you're going to see the services. You can just subscribe to the Forex or just subscribe to the stocks, which includes also ETFs, commodities, and indices, and stocks, or subscribe to full access, so Forex and stocks. So this is what you get. This is your breakdown. For the Forex, commodities, and indices, you'll get all the currencies and you'll get commodities and indices as well. So quite a large number of markets here. The euro, pound, Aussie, dollar, yen, dollar, Canada, dollar, Swiss, New Zealand dollar, euro, yen, Bitcoin, Ethereum, S&P, Dow, NASDAQ, Russell, DAX, FTSE, dollar index, 10-year bond, gold, silver, natural gas, and oil. Wow, that's a lot. That's a lot. So that's for the Forex. For the stocks, Apple, Amazon, AMD, BABA, Facebook, Meta, GM, Google, JP Morgan, Netflix, PayPal, Nvidia, Tesla, Twitter, and then ETFs, XLF and XLE, in addition to the commodities and indices. And then if you get full access, you get it all. You get it all. So it's $19 a month. And then depending on what you subscribe to, it'll be either $75 a month or $99 a month for full access for everything. That's a really good, really good price. Now, this is what you also get. Juan does a daily Elliott Wave report with the daily 4-hour and 1-hour charts from Monday to Friday, and then a weekly and a monthly report, and daily videos. For the Forex, it's daily, Monday to Friday. For stocks, it's 2 days a week, Tuesdays and Thursdays, with trade ideas, targets, invalidations, and strategies, which is exactly what he talked to you about today. So how he talked to you today is exactly what he points out in his videos. How great is that? And daily commodities and indices, Elliott Wave analysis video. So there are 2 videos for the Forex and the commodities and indices. And with the stocks, you're going to get the individual stocks 2 days a week, but you get the commodities and in the indices 5 days a week. Then you get your Forex and futures and stocks and futures swing trade ideas with entry and stop loss on the website and through Telegram, just what he told you about now. And he started a members academy with education, basics, risk, strategies, tactics, Elliott Wave crash course with new lessons every week. So this is really a great product, a great promotion. ElliottWaveDesk.com/join. And I want to tell you now about the results of the Elliott Wave Desk trade alerts. You receive trade ideas on Telegram with the entry price, stop loss, and take profit levels. The trade ideas are explained in the daily video from the Elliott Wave and price action perspective. And since 2017, this is a track record, we've shared 535 trades and 13,671 pips in profit. So very consistent, as you can see from the graph. During 2022, we are positive 2,282 pips. Well, that's great since most of the market is in negative territory if you're trading stocks. This is just fantastic. So our plan of sharing real-time trades is to teach how to trigger using our exclusive Elliott Wave approach. And if you had a $10,000 account risking 1% a trade per trade since 2017, the current equity is at $44,853. And the smooth equity curve demonstrates that the drawdowns are small compared to the gains and that the strategy works over time. So this is fantastic. So once again, ElliottWaveDesk.com/join. You don't lose anything. If you've attended this webinar, you got to sign up, okay? Because the benefits will outweigh not signing up, the benefits that you get from this. even if you have your own strategy. So Wadid, I want to thank you very much for being here. You can contact us with questions, support at fxtradersedge.com. And we look forward to seeing you on the inside in the Elliott Wave desk. And that would be elliottwavedesk.com/join. So thank you very much, everybody. Signing off.